Good morning, everyone. I'm delighted to be here today. It has been 9 months since the pandemic first gained a foothold in US, bringing with it the sharpest downturn on record. Just as good recipes are crucial in preparing a good Thanksgiving dinner, the proper policy recipe will be important for economic recovery. So today, I will offer a current assessment of US economic conditions and also highlight a policy recipe for economic recovery going forward. Moving on to my first slide. Let me start with the key themes on my talk. The US economy saw a strong rebound in Q3 from the second quarter's historic fall-off. However, the recovery has been incredibly uneven as different sectors were hit by the virus very differently. While some sectors have seen a full recovery, demand still remains well below the pre-pandemic level for sectors that need intense in-person contact. The current crisis is first and foremost a public health crisis. How effectively we can contain the virus spread will underpin how fast the economy can gain a full recovery. Turning to fiscal policy, the strength in the overall rebound was supported by fiscal stimulus measures passed early this year, which were timely, targeted, and unprecedented by historic standards. However, the earlier fiscal support is fading, which is prolonging the recovery. Going forward, effective health and fiscal policy responses will be essential to economic recovery. With that, let me dive into the details. Turning to the next slide. US GDP rebounded in the third quarter. The left chart shows that following the second quarter historic fall-off in economic activity, the real GDP in Q3 increased at an annualized rate of 33%, the fastest pace of a quarterly growth on record. As impressive as this bounce back was, the right chart shows the level of real GDP in Q3 was still lower than its pre-pandemic level by 3.5%. These two charts highlight that US economy has seen a strong rebound so far, yet it still has a long way to go before we see a full economic recovery. Turning to next page. Despite the quick rebound, the headline numbers mask the underlying uneven recovery across sectors, as the pandemic hit different sectors very differently. To put it into perspective, I compare the current crisis to the Great Financial Crisis. The left chart shows that during the Great Financial Crisis, retail sales declined across all categories at a somewhat gradual pace. Turning to the right chart, however, in the current crisis, household spending has been incredibly uneven across categories. The latest data shows that in September, there remained significant gaps between different spending categories. I will provide more details in the wide dispersion in the next couple of slides. Turning to the next page. In the recovery, some sectors have come out ahead. The left chart shows that sectors like bicycle and personal computers were little affected during the lockdown in the spring. Since then, the demand has been rising at a faster pace than historical norm, with many people working from home and exploring outdoor activities. The right chart shows that the demand for other durable goods like furniture and motor vehicles dropped by close to 20 to 30% during the lockdown. But since then, the demand has risen well above its pre-pandemic level, as people spend more time at home and also drive more and fly less. Overall, these two charts highlight that some sectors, in particular durable goods sectors, have seen a rapid recovery. Turning to next page. Although some sectors have come out ahead, other sectors are lagging behind. This is particularly relevant for sectors that provide service and needs intense in-person contact. The left chart shows that food and dental services saw a sharp decline of more than 50% during the lockdown. Since then, both sectors have seen a partial recovery, with consumers returning to restaurants, bars, and resuming their dental appointments. However, the demand remained below its pre-pandemic level as consumers continue to take precautionary measures. The right chart shows that certain service sectors have barely seen any recovery. Live entertainment and theater activities essentially halted during a lockdown as demand vanished. Since then, both sectors have not seen much improvement. Overall, the wide dispersion across sectors is prevalent as the pandemic has had a distinct impact on different sectors. Turning to next page. Continued increases in COVID cases weigh on service spending, in particular, the accommodations and the food service spending. The green line shows the new COVID cases on an inverted scale. The blue line plots the spending on accommodations and food services. The four arrows show that the spending has tracked the COVID development very closely. Specifically, I want to highlight that the spending remained flat during the second wave in June and July, as the second arrow shows, and also stalled since mid-September, as the fourth arrow shows here. We don't have more recent data on the spending yet, but the very rapid spread of virus recently is likely to further depress the rebound in this category. Overall, the spending in leisure and hospitality is stagnant. Turning to next page. Turning to next page. The stagnation in spending on leisure and hospitality will weigh on employment growth, as this sector has made the largest contribution to payroll gains so far. The blue bar shows the jobs that have been recovered in each service sector between April and October, while the green bars show the jobs yet to be recovered. I would like to highlight a couple points. First, the sector of leisure and hospitality is the largest contributor to the job gains since April. The blue bars show that this sector has gained about 5 million jobs, counting for close to half of overall job gains. Second, this sector still has a long way to go in order to return to the pre-pandemic level, with 2.7 million jobs yet to be recovered. The slowdown in related consumption, as shown in the previous chart, will weigh on the job recovery in this category. Finally, besides leisure and hospitality, other sectors also have a long way to go. For instance, the sector of information sector has barely recovered as the job losses concentrated in the movie industry. These and the previous pages highlighted that the continued spread of virus will weigh on the labor market recovery. Next, I will turn to the international perspective of the spread of COVID. Turning to the next page. The second wave in Europe will slow down the rebound in export activities. The left chart shows that the first wave of COVID cases peaked in April in Europe, as European countries imposed lockdown measures. The COVID cases declined and remained low in the summer. Since August, however, European countries have seen sharp increase in their COVID cases at record high levels. The COVID development in foreign countries has direct impact on US exports. The right chart shows that goods exports and imports both declined sharply during the first wave with lockdowns. In the summer, both trade activities bounced back quickly, but imports have recovered at a faster pace than exports. With the second wave surging in Europe, export activities will slow down further. So far, I have highlighted that recovery path going forward will crucially depend on the containment of the spread of virus, as the current crisis is first and foremost a public health crisis. Next, let me turn to fiscal policy. Turning to next page. The quick rebound in economic activity that we have seen so far, supported by timely, unprecedented, and targeted fiscal stimulus. The left chart compares the CARES Act, which was passed early this year, to the key fiscal measure taken following the 2008 financial crisis, the American Recovery and Reinvestment Act. The bars show the spending of those two bills as a share of GDP after the start of the recession. I want to highlight 2 points. First, the CARES Act was passed and implemented in a much shorter period of time, with most of spending being front-loaded in 2020. On the other hand, the bill of ARRA was not passed until the second year after the start of recession, and the stimulus measure was spread over a couple of years. Second, the fiscal measure taken this year is unprecedented in terms of scale, as the spending counts for 80% of GDP, while the spending of ARRA peaked at 2.2% of GDP. The right chart highlights the CARES Act is more directly targeted to business and households compared to ARRA. In particular, it allocates close to $900 billion to loans and grants to business sector, which was absent in the previous measures following 2008 crisis. On the other hand, the ARRA mainly consisted of tax cuts and other spending. Overall, fiscal measures that were passed early this year were timely, unprecedented, and targeted. Turning to next page. Those extraordinary fiscal measures supported the rebound in economic activities. The left chart shows unemployment benefit, which is a rate, which is horizontal green dots 1996 and December 2019. It is upward sloping, implying that as unemployment rate increases, more people apply for unemployment benefit, and therefore the UI spending increases as well. The blue solid line shows that unemployment rates increased sharply early this year from a historical low of 3.6% in January to a historical high 14.7% in April. During this period from January to April, the increases in UI benefits largely followed the historic pattern, as the solid blue line is quite close to clustered green dots. After the passage of the CARES Act, the UI benefit increased tremendously in May, and the blue line deviated significantly from the historic pattern. The fiscal support stayed at elevated level until July, but has been fading in more recent months. The right chart shows that the unprecedented fiscal stimulus has supported the rapid recovery. The blue line shows that consumer spending per capita declined in March and April, but saw a V-shaped recovery in the summer. This quick rebound was supported by sharp increases in UI benefit. More recently, UI benefits have declined with fading fiscal support, and the consumer spending continues to recover, but at a much slower pace. Overall, earlier fiscal measures supported recovery, but those supports are fading now. Turning to next page. Besides supporting the quick rebound in economic activities, fiscal stimulus measures has also boosted personal savings. This chart highlights the personal savings rate is currently at a level that is significantly higher than historic norm. With fading fiscal support, the question is whether people will dip into their savings to support their consumption in the near term. Turning to the next page. Based on the staff analysis at the KC Fed, we find that not all savings will support near-term consumption. In this chart, I split savings into 3 categories. Typical savings in normal time show as in the yellow bars. The orange bars show the savings associated with precautionary motives, meaning consumers pull back from spending in response to possible lower future income. Instead, people save more as a buffer. This type of saving is unlikely to support near-term consumption. Finally, the green bars show savings that are induced by government transfers, which in general are associated with higher spending in the near term. The decomposition in 2020 shows that a combination of precautionary motives and the government income transfers have kept the savings rate elevated. In particular, more than half of excess savings was due to precautionary motives and is unlikely to be spent in the near term. Therefore, despite a high savings rate, the growth of household consumption is likely to moderate. Turning to next page. There are significant amount of uncertainties on the next round of fiscal stimulus, which poses downside risk to the economic outlook. The chart shows the wider range of fiscal stimulus proposal from House Democrats, the Treasury, and the Senate Republicans before the presidential election. The three bills have very different cost estimate, ranging from $500 billion to $2 trillion, and they also have very different spending priorities. This page highlights significant uncertainty surrounding fiscal stimulus, and the delayed fiscal support will prolong the recovery. Turning to the next page. Let me first summarize. Effective public health policy and targeted fiscal policy are essential to economic recovery going forward. First, the recovery has been incredibly uneven across sectors as the demand for sectors that require intense in-person contact remain well below the pre-pandemic level. And the continuous spread of virus poses significant downside risk to the economic outlook. Therefore, effective public health policy is essential. Second, the Congress passed timely, targeted, and unprecedented fiscal stimulus measures earlier this year, which supported the quick rebound in economic activity. However, those earlier fiscal supports are fading, and the targeted fiscal stimulus going forward will be important in the near term. Then a natural question will be, with the massive fiscal stimulus measures, should we worry about the rising government debt? And that is a special topic I would like to discuss next. Turning to the next page. Recent fiscal measures that have benefited households and business tremendously, but they also have significantly deteriorated debt projections. Will that raise debt sustainability concerns? How much debt is too much? The conventional way of gauging fiscal risk is to look at the country's debt over GDP ratio. In this special section, I would like to emphasize that just looking at the debt GDP ratio itself is not sufficient. Instead, both the debt over GDP ratio and the government ability to service a debt will matter. Importantly, a government ability to service a debt will depend on its potential to raise tax revenue and cut government expenditure in the future. So let me dive into the details. Turning to the next page. Extraordinary fiscal measures that Congress took earlier this year has significantly deteriorated debt projection. This chart shows that the Congressional Budget Office currently projected federal government debt to rise to about 100% of GDP in 2020, up from its projection of 80% made 1 year ago. It also expected debt to reach close to 200% of GDP by 2050. Turning to the next page, given the rising government debt, an important question for policymakers is, how much debt is too much? People often look at the debt to GDP level and they try to gauge the fiscal risks. But there is a missing piece in these discussions, which is government ability to service debt. I will call it the fiscal limit. Each country faces fiscal limit because government cannot indefinitely increase revenues by raising tax rate. Second, the government faces rising expenditures due to demographic changes. Just as corporate debt, the government capacity to issue and service debt will depend on its future cash flow, which is the difference between the tax revenue and expenditures. If its future cash flow are expected to drop, then its capacity to service debt will decline. Therefore, the fiscal limit depends on future fiscal policy. Turning to the next page. Each government faces a limit in raising tax revenue for economic or political reasons. From the economic perspective, tax changes people's incentive to work and invest. Even Alexander Hamilton wrote on that point in the Federalist paper. He wrote, if duties are too high, they lessen consumption. The collection is eluded. And the product to the Treasury is not so great as when they're confined within proper and moderate bound. The intuition is following. If the household and firms don't respond to tax changes, then a higher tax rate always raises tax revenue. However, a higher tax rate makes people to work less and invest less. This chart illustrates the relationship between the tax rate and the tax revenue. In general, raising tax rate could increase revenue when the existing tax rate is relatively low, and it will reduce revenue if the existing tax rate is already very high. More broadly, there may be limits to raise taxes due to political reasons. So overall, a government faces a limit in raising the revenues at some point. Turning to next page. On the other hand, US federal spending is projected to rise because of Social Security and healthcare program, mainly due to the aging society. This mandatory spending as a share of GDP was below 5% in 1970, increased to about 12% in 2020, and is projected to rise further to about 15% in 2050. The combination of the constraint in raising tax revenue and the rising government expenditures due to the aging society gives rise to the fiscal limit. So what are the fiscal limits in US? Turning to the next page. My research shows that debt sustainability in US is not a concern yet. So before getting into the number, let me first explain how to interpret this chart. With uncertainty about future economic conditions, the government's future cash flows are also uncertain. Therefore, its ability to service debt also comes with some uncertainty. This chart says the probability of a government running into a debt sustainability issue increases with the debt over GDP level. Now, turning to the numbers. The blue line here shows that if the government can tax economic activity within a historical range, and if it will adopt a reform to stabilize the mandatory spending as a share of GDP in the next 30 years, then the blue line shows that the fiscal limit for US. With government debt at 100% of GDP, the probability for the US government to run into a debt sustainability issue is essentially zero. Now, turning to next page. Debt sustainability in the longer run will depend on future fiscal policy. In particular, if the government may be able to raise taxes beyond the historical levels, in that case, government has a higher fiscal limit, as shown in the orange line. On the other hand, if a government spending increases at a faster pace, and the government cannot adopt fiscal reform to stabilize the growth of its expenditure, then it will lower the fiscal limit, as shown in the green line. In all three cases here, the debt sustainability is not a concern for the US federal government in the near term. And therefore, the government should take targeted fiscal stimulus measures to support the recovery in the pandemic. In the longer run, however, debt sustainability will depend on future fiscal policy, specifically whether the government could raise tax or cut back on expenditures. So that concludes my presentation. I'll be happy to take any questions you may have.
Hi, Wei Shen. Well, thank you for such an amazing presentation. I learned so much, and this was very, very illuminating. So we do have some questions queued up in the Q&A. So I'll just kind of go through the order here. The first one is from George Richmond, and his question is, tourism and travel are important industries. So what is your current view on how they will recover, and if passport renewal would be an important indicator?
Sorry, can you repeat the question?
Sure, yeah. So George Richmond talks about how tourism and travel are important industries, and he is asking your views on how they might recover and if passport renewal would be an important indicator in that.
Right. I think a passport renewal would be an indicator, particularly for international travels. And I think, the vaccine, the recent, very positive news on the vaccine has been helped, certainly we see from the stock market in the airlines. And so I think ultimately, how fast the people will go back for the travel or, hospitality services, it really depends on how effectively we can contain the spread of the virus. We have the vaccine, probably hopefully ready soon. But then there is also issue about how many people are willing to take those vaccines, how fast we can distribute those vaccines. So there is still a lot of uncertainties. But on the other hand, I also hear that people have been at home for so long, they are willing to make up their travels. Not only they're going to have their travels next year, they may be willing to make up the travel missed this year. So that's, I guess, a good news for the sector.
Yeah, absolutely. Thank you for that. And I just want to sort of piggyback off of something that you just said. And it's been relatively recent within the last week or so that we've had several announcements about vaccines and being 90% effective, 95% effective. How do announcements like that, or what is your prediction for announcements like that affecting the economy in the near term?
So I think, it certainly has a big impact on the stock market in terms of a real economic activity. It may be more in the medium term, in the sense that when the vaccine is actually distributed, people, hopefully the majority of the population is willing, is open to take those vaccines, and then would be effectively containing the spread. In the very near term, I think the impact is probably going to be more limited because, as I just showed, if the COVID cases continue to increase at the same time at a very fast pace, it's going to contain, people are going to take precautionary measures, and it would probably going to affect, manufacturing activities as well, because it's going to affect how many people have to probably take the testing, and therefore affect the staffing as well from a firm perspective. So I think in the near term, there is a significant amount of downside risk, and the vaccine probably is not going to be help a whole lot in the near term. The way I see it is like, we kind of see where we are heading to with the vaccine news, and we need some bridge to get in there. And so, if we can contain the virus spread, and also, if there is additional fiscal support, targeted fiscal support, bring us through the bridge, that will be it's going to be very good news for the recovery. It's just we have significant uncertainty in terms of fiscal support at the moment.
Yeah, absolutely. Well, thank you. So another question that we had, and I'll actually take this one, is if this presentation will be available offline. And so if you see in the chat, I did put my email address, which is chloe.davidson@kc.frb.org. If you are interested in receiving this presentation, feel free to email me and I will get it to you after our meeting today. So the next question that I will go to is, let's see. So Wei-Shin, your thoughts on the stimulus being responsible for keeping the stock market not only strong, but increasing. So I know you just talked a little bit about the stock market and the economy and that relation there, but if you could just talk a little bit more about if the stimulus is responsible for keeping the stock market not only strong, but also increasing.
Yeah, the stimulus package certainly had an impact on the stock market. For one thing is that, for instance, fiscal stimulus package, that to the extent it could help in the household spending, the consumption, and it also helps that the firms avoid bankruptcy. That probably raise the prospect of the gains from the stock market. On the other hand, from the monetary policy perspective, we have had, large amount of asset purchasing, in the March and April. We see the market, not just the stock market, but in general, liquidity was really dried out. And the Fed stepped in and really restored the kind of liquidity function of that market. So it would partially going through the stock market to some extent for that function to work. So I think, you're absolutely right that stimulus has been not only keep the real activities going, but it also contributed to the stock market rising. And of course, with the positive from the vaccine news, it also helps. And so I think that different factors probably contribute to that.
Yeah, absolutely. Thank you for that. Let's see, going through some of the other questions that we had in the chat. One of them is from Paul Sowards. Will the recovery be uneven amongst states based on their healthcare policy? So is there some correlation between recovery in the states based on the policy, the healthcare policy that's implemented in each of the states?
Absolutely. So I did not have a chart here, but if you look at across geographic locations. So for instance, if I take Ohio and Texas as example, so Texas was less hit than Ohio in the very beginning. So in Q2, their data was coming stronger than Ohio. But then in the Q3, Texas got really hit. And therefore, the Q3 number is actually coming below the Ohio. And therefore, the recovery has been slower than Ohio. So that is really one example to show that, just as an unevenness across sectors, the unevenness across geographic locations is very much tied to the virus. That, for the sectors or the geographic locations that you are more hit by the virus, and therefore the state government or local government may take some measures to contain that virus, that certainly had a negative impact on the local economy. Yeah, so that's what I said, the recipe number one is, the virus, contain of the virus. That's a key.
Yeah, absolutely. Well, I see some questions here in the chat about oil prices and gas being a huge part of the industry in Oklahoma. So one of the questions specifically is, how much are current oil prices directly correlated with the pandemic response, and what might be the projected lag on oil prices when the economy begins to open up?
Right, that's a good question. And the oil price, the projection is that it's going to gradually increase with not only hopefully the U.S. economy going back, and also the world economy. Like for instance, China has been emerging faster than other economy. And I heard anecdotal evidence, for instance, that the Chinese economy, because they also had a lot of fiscal stimulus, there are some infrastructures, power project has been restarted. So for the companies that in US, which export, power-related, energy-related infrastructures product to China, has seen increases. So I think, to the extent when the virus is contained, because fundamentally I see that the economy, US economy is strong. It's just the virus is contained those development. And the hope is that with the policy measures, fiscal policy measures, monetary policy measures, we can contain the longer run scaling effect. That hopefully with a vaccine, when the virus is contained, that we can quickly rebound, and that would help, certainly would help the economic activities, and it would help the oil price for sure, yeah. And also I see in the charting, there is a question about the modern monetary theory as a solution to fiscal policy. So I could comment on that as well. So in my fiscal analysis at the end, that is, I take it as I'm not taking into, I'm assuming that the US government debt would have to pay off that debt as the real debt. So I'm not considering the scenarios that inflation would go really high, that inflated away some of the debt liabilities. But historically, what really gonna help if the policymaker is even willing to go down that path, it's not inflation itself. It has to be the inflation surprise. In the sense is that if people expect inflation is going to go very high, that's going to reflect their bond yield, and therefore it's not going to be really help with government debt. It's only the inflation surprise that's going to help. And so, so I don't think that's a very sustainable way. Like for the Fed's mandate, we have inflation target, and we also have the maximum employment. So it's dual mandate. So the currently inflation is running below our target. So we are taking extraordinary measures to hopefully keep the inflation to the target over time as the economy recovers. But we certainly don't want inflation to run very high, as we have learned from the historic episode as well. So that's my personal thought on that.
Yeah, absolutely. Thank you for sharing. I am kind of combing through some of the questions, and I am seeing one about one of the last charts that showed federal debt as it related to the GDP. And there's a question as far as where is the US federal debt today as compared to GDP on the chart. So I can go ahead and pull the chart back up again if that would help, but if
Sure.
you'd be comfortable talking a little bit about that.
So yeah, so is this question is in the chart? Maybe you do help me if I see that question.
Yes, and I can repeat the question too. It is in the
Sure.
Q&A feature, and the question is that the last chart shows federal debt as it relates to GDP, which saying that that's not a concern for the U.S., but where is the U.S. federal debt today compared as to GDP on this chart?
So yeah, so the horizontal axis here is showing the debt as a share of GDP. So in a sense is that if the GDP is growing and if the debt is growing at the same path as the GDP, even though the nominal level may be still growing, but if it's growing at the same pace as the GDP, then in this chart here, it would be the same. For instance, 100% of debt to GDP ratio means that even the GDP is growing at 3% the next year, and even the debt is growing also at 3%, it would be still the 100%. So I don't know whether that answers a question that I raised here.
Okay, thank you. I think that was a great explanation. I am looking at a question too in the chat that talks a little bit about education, and this one is from Tracy Langley. And Tracy's is, so she says, you know, some of your listeners are going to university next year, and do you think that the school year in 2021, 2022 will be on campus or learning remotely, which, you know, might be a hard question to predict out into the future, but maybe you could talk a little bit about, you know, how policy impacts higher education, or if you know, have any insights on that topic.
Yeah, for sure. I think, you know, the current, the virus, the situation is affecting the college and affecting other, you know, in general, like K to 12 as well. In general. So I don't know about in the prospect whether, you know, the college will reopen, whether student could be all in person next year or not. I do hope so. But I think, you know, as we learned, you know, as wonderful as technology is, you know, nothing can really replace in-person learning, right? So I'm sure the students are gonna learn a lot more in person. And there have been studies showing that it's not for the college student, but showing from the elementary school, the K to 12, is that this pandemic, that the remote learning or some deficit in terms of how much they learn, is going to have significant impact on their human capital going forward. And there is, you know, it's still very tentative, but certainly people understand that it's an important issue. And another thing related is actually, you know, as also related to K to 12 more probably, is that, you know, with a lot of kids learning from home, that affected how many people could go back to find a job and lower the women labor force participation rate. That certainly is also an issue that not only gonna affect the firms staffing, but also could affect the women who if they decide to stay out of labor force for some period of time, they're gonna have a longer term scarring effect. So yeah, I'm very sympathetic to that. You know, it's the education, you know, it's affected very profoundly to young people and also to people who have younger kids as well.
Yeah, absolutely. Well, thank you. And I am seeing another question. We're really getting questions from, you know, a number of different fields and types of different things. And so one of the questions from Dan King is saying, you know, you show different types of stimulus between UI, business, taxes, and other. Is generally one type of stimulus more effective at impacting the economy in the short run?
Right, that's a really great question. So, for the household, for instance, there are two major types of stimulus. One is a stimulus check, and the other is a UI benefit. So what the staff analysis, what we find is that the stimulus check, which we also had, you know, the Bush stimulus check as well, it tends to be, it's kind of broad based. There's no income threshold to that. Most of those money went into the savings instead of people spend it. So there is kind of things, you know, if you give people $1, how likely they're going to spend that dollar, or, you know, how big a portion they're going to spend. So from that, you know, the stimulus check, you know, people tend to spend a smaller share out of that. But on the UI, on the other hand, because you are giving the money more to the targeted people who are probably more in need of the cash, they tend to spend a larger share of that money. So in my chart I showed is that the consumption that bounced back in the summer, it's really very much consistent with increase in UI benefit at the same time. While the stimulus check actually was picked before that, that is more consistent with really increasing savings rate, but it's less so with consumption. So you're absolutely right. The targeted fiscal policy stimulus is going to be very important at this stage. We don't want to give the money to everyone. We want to give the money to the people who most need it and to the business most need it, I think.
Yeah, absolutely. Okay, well, we are coming up on time, and so I will say this might be our last question. And I want to say thank you, to the audience. This has been lots of really great, thought-provoking questions here. Unfortunately, we won't be able to get to all of them, but thank you for your questions. And if you are interested in the slides, feel free to email me. I'll put my email again in the chat, and you can have the slides afterwards. So sort of our closing question, Wei Shen, will be, it's going to come from the chat from Neil Stanley. And the question is, the money for nothing concept that arises out of government programs can, dilute our understanding of principles of economics. Economics is about production and allocation of resources and consumption. So the question there is, what are your thoughts on the public's growing disconnection from concept that our consumption is limited by what we can produce?
Yeah, I think that's a great question. So I think the idea here is that we wanted to kind of keep the economy going when the pandemic, at the earlier stage of a pandemic. What I thought was, from a policymaker's perspective, is that if we could contain this pandemic, we take lockdowns, we give very extraordinary fiscal measures, monetary policy measures, that would carry us through. But that was not as smooth as we hoped. The virus still continued, and we cannot keep the economy locked down for a longer period of time. So, but the idea of having a fiscal stimulus is that you could keep so not only give the money to people spend, but also it allows the business to hire people because there is demand for their product. Therefore, they can produce. Therefore, you can keep the economy going on. What we are worried about is, there is a cut off, the demand goes down, and firms could not produce, and therefore, it's going down, and we drag on, right? So that is what we want to avoid. But you are absolutely right, is that, if you pump so much money into the economy, and you actually only leads to inflation, in the sense you don't really get your economy produce more or growing faster, it's just coming with more information, then it's not our goal, right? It's like, okay, if you produce one pie, but if you just pump up more money, you still have only one pie. It only raises the price for that pie, right? The hope is that when you pump more money into the economy, at least at this stage, we think that if it's targeted fiscal policy, that could make the pie bigger, because more firms could make the pie, and therefore it's beneficial for the economy. But I'm sympathetic to your concern, and that's definitely what I'm saying. It's targeted fiscal policy, and we do, in the longer run, we have to consider about our fiscal sustainability concerns.
Yes, absolutely. Well, thank you so much, Wei Shen, for such an economic presentation today, a great outlook, and also for answering so many of the questions that our viewers had. If everyone would like to give her a virtual round of applause through comments in the chat, since we can't see or hear you, feel free to go ahead and put those in the chat and say thank you for your time today.